Now we also leg into debit spreads, and we use Prime Trade Select to select a trade, and it's produced a lot of winning call option purchases. So what we do is, if we have a money management rule, if we purchase a call option and we have a 30% or higher profit in the call option purchase, then we'll sell to open a call option with a higher strike price at a later date to establish a debit spread, and this is known as legging into the debit spread. And when you sell to open a call option, your trading account receives a cash credit for the option premium that you sold. So if you sell to open a call option with a 4-point premium, $400 in cash is credited to your brokerage account. And if you purchase a call option and that call option increases in value, the sale of the call option at a later date generates a cash payment, and that cash payment will increase the profit potential of the existing call option purchase by as much as 100%. And it will also provide downside protection in the event the underlying stock declines in price. So when you leg into a spread, you accomplish two things. It increases the profit potential of the existing call purchase and provides downside protection. And it also reduces the cost of your option purchase, and then that will reduce the risk, your dollars at risk, and we'll show you an example of that. So with a bullish debit spread, the call option that you purchase, of course, will profit if the price of the underlying stock or ETF increases, and the call option that you sold will profit if the price of the underlying stock or ETF decreases, and your risk is limited to the cost of the spread. So let's look at an example of a leg in. AMAT is a symbol for Applied Materials. AMAT was on a Prime Trade Select buy signal. So our brokerage report shows that we bought the 40 strike call at 7.78. We had a $13,000 profit in the trade. So we used our money management rules, and once we have a profit in a trade, then we want to protect that profit in case of a market correction or if the underlying stock goes down in price. So we sold to open at a later date the 50 strike call at 375. So this created an option debit spread that expired about 5 weeks later. And at the time, AMAT stock was trading at 52.48. So we bought to open the 40 strike call. We had a profit in the call purchase. So at a later date, we sold to open the 50 strike call at 375. So if you subtract the premium from the option sold of 375 from the premium of the option purchase, 778, you come up with a net debit of 403. So this spread cost $403, and this reduced our dollar risk from $778 to $403. So by selling to open the January 50 call, we increased the profit potential of the call option purchase, and we also reduced our dollar risk from 778 to 403. So with AMAT trading at 52.48, when the trade was initiated, we bought the 40 call, sold the 50 call, so this was an in-the-money spread. And as I mentioned, the in-the-money spreads give us more downside protection and a higher probability that the trade will be profitable. And these spreads can profit if the underlying stock is down as much as 10% at option expiration. So let's look at the debit spread analysis here, this is another one of our calculators, and this will calculate the profit potential for the debit spread, assuming various price changes in AMAT at option expiration. In this example, from a 10% increase in AMAT to a 10% decrease in the stock at option expiration. So we can see that if AMAT is flat at option expiration at 52.48, then the spread will realize a $597 profit and a 148% return. So when you leg into a debit spread, you're going to get higher returns because you already have a profit on the option that you purchased. So in this example, if the stock is flat at expiration, we'll have 148% return. And if the stock was down 10% at expiration to 47.23, we'd have a 79% return. So in this case, if the stock is flat at 52.48 or increases at all at option expiration, we're going to have a 148% return. If it's down 10%, we'll have a 79% return. So profiting when your stock is flat or down 10%, again, will give you a much higher probability of success as a trader compared to just taking directional trades. So we always like to leg into a spread whenever we have a profit on a trade, on a directional trade. We automatically will leg into a spread to protect those profits. Now, selling the AMAT 50 strike call for 375, that resulted in an 80% increase in the profit potential of the 40 strike call purchase. So we bought the 40 strike call, had a profit in that. When we sold the 50 strike call, that increased the profit potential 80% for our 40 strike call. And of course, that also provided downside protection in case AMAT declines in price. Let's look at another example. This is for ISRG, Intuitive Surgical. ISRG was on a prime trade select buy signal. So our brokerage account shows that we bought the ISRG 280 strike call at 45.60. We had a profit in it, and we sold to open the 370 strike call at 15.10. So this created an option debit spread that expired in 5 weeks, and at the time ISRG was trading at 379. So bought to open ISRG 280 strike call at 45.60. We had a profit in the 280 strike call purchase, so we at a later date we sold to open the 370 strike call, and so this was an in the money spread with ISRG trading at 379 at the time we legged into the spread. So again, the in the money spreads give us more downside protection and a higher probability that the trade's going to work out. So let's look at the profit potential for this trade, and we can see if ISRG was flat at option expiration at 379.24, we would realize 195% return and a $5,950 profit. So that's a pretty good return if your stock's flat at option expiration. That's a pretty good return. If ISRG was down 10% at 341, we would still realize a 101% return. So these option spreads are the way to go. If you have a directional trade and you have a profit in that trade, you don't want to give up that profit if the underlying stock corrects. So we always create a debit spread to protect those profits. And this greatly increases your chances that you're going to be a winning trader. So just to summarize, with legging into debit spreads, the advantages are you increase the profit potential whenever you leg into a debit spread. You increase the profit potential of the existing call option purchase by 50 to 100% or more. And if we could see in that AMAT spread trade example, when we sold to open the 50 strike call, that increased the profit potential of the existing 40 strike call purchase by 80%. It provides downside protection. If you sell to open a call option, that results in cash being credited to your brokerage account, reducing the cost basis of the option purchase. And then, of course, the short call provides downside protection in the event the underlying stock declines in price. It can reduce risk substantially. We saw on the AMAT spread, it reduced our dollar risk from $778 to $403. And the spread can be profitable if the stock goes up or down. And we saw two examples there where even if the stock drops 10%, we're still going to realize a profit on the spread. So let's next talk about, well, first, I just wanted to mention we have an option trading service, and we make recommendations for debit spreads, and email alerts are sent to members with instructions whenever we have a new debit spread trade recommendation or if an existing trade is closed out. So we maintain a open trade record and a closed trade record, so we account for all trades with our option trading service. And as a member of the option trading service, you get access to those 6 option calculators for the different optioneering strategies. And this is a snapshot, a recent snapshot of the open trade profits for our debit spread portfolio. So we have a debit spread portfolio where we make trade recommendations for debit spreads. And when we took the snapshot, we had $303,000 open trade profit and an average return of 351%. So these debit spreads have been performing well this year despite all the market volatility. And as you saw, we can profit even if the underlying stock declines at price at option expiration. So if you want to get the latest trade results for our various strategies, we have option purchase, we have covered calls, we have option spreads, and we have market neutral or profit guard spread. So if you wanted to see the current performance, you could just log on to weeklyoptionalert.com and click trade results, and that'll show you the current performance for these various strategies. And if you're interested, you can call Brad at his toll-free number or his 310 phone number.